it is. I found it. Awesome. All right. Welcome everyone to our very interesting webinar here. How you can use the bank's money for free sometimes and pay off your debts within 21 days. So I want to share with you, like I mentioned, a few bank secrets that not a lot of people are aware of, and those who are aware of, they're not really using it. And so it doesn't matter if you know the secret or not, like if you're not using it for your advantage, it's irrelative. And I also want to share with you a very good mortgage product that allow you to pay off your mortgage faster just by switching your existing mortgage into a new one, as well as a fantastic strategy called Smith maneuver at the end of the presentation here. And also you will see, we'll give you some bonuses here, as well as we will open up for Q&A. So my name is Konstantin, and I'm just originally from Russia. I had multiple businesses in different countries. So I like businesses, I like investing, and I like helping people to actually take this knowledge and apply. I am a licensed mortgage broker. We serve clients in Alberta and BC, and I also a private lender. We have our own small 7-digit fund where we lend money to clients and we raise money to help investors to generate healthy returns. I wrote a book about private lending in Canada. I also published on Amazon my success journal. I strongly believe in gratitude, and I believe that you need to help people, and it's kind of my duty and responsibility to help you. And one of the strategies is just be grateful. I have an engineering degree back in Russia, so I have extensive experience in land and engineering side of things back in Russia. But when I came to Canada, I have to restudy again, so I choose a different path, and I call myself financial engineer right now. I take very complex solutions, like the strategy I will mention in this, and then make it simple for people to consume. So I call myself financial engineer. And I also like donate people. I like donate money. I like to help people. And my favorite charity is kiva.org. With small donation, you can help a lot of families around the globe. So I also have, like I mentioned, a small fund, and we have direct investors that we are working with, and I source files for them so they can fund and enjoy cash flow. We also help 300 clients, families to kind of convert their right strategies into a right mortgage. I've looked over 4,200 files right now. I need to update the slides here, and I picked the right solutions for my investors. Been in business for half a decade here, and I've done over 760 loans in third world countries through the Kiva. But I want to ask you a question here. Like, I just need to know who is here, who wants to buy a property, and they're looking for better borrowing solutions. So it's actually convert their mortgage into a right product, or somebody who is just new to the game and is renting right now, and they want to get into this, and they gathering some information. If you can type in the chat room, if you're owner or a tenant, so you actually know who we're talking to, so you can adjust the presentation a little bit. Because it's very important, like if you're owner and you have a mortgage already, you need to understand these new techniques, because banks doesn't tell you that. But if you're a tenant and you're renting right now and you're planning to buy, you're in a right path, because you need to plan ahead to make sure you get the right product, not just whatever banks tell you. So another question I have for you guys is, what do you think is more important? Interest rate, that's right now you can get 1.9%, 1.89%, or it's more important to have a nice term that allow you to exit the loan, that allow you to have portability and other things. So what do you think, guys? What is more important, rate or term in your mind? And there is, by the way, there is no right or wrong answer. Yeah, I see you have a couple of owners. There is no mortgage landlord terms. Yeah, you're right, because it looks like your experience, because you probably got burned with a very low interest rate. Even right now that people saying, oh, HSBC giving you like 1.6%, 1.7%, 1.8%, 1.9%. And I can tell you, I can get you like 1.8 or 1.9%, but you might not be qualified for that. It's just kind of marketing techniques. And also another thing is the term allow you to pay off your mortgage faster than the interest costs that you might be saving switching from 2% mortgage to 1.8% or from 3% to 2.5, because rate, to be honest, doesn't really matter. It's like a size doesn't really matter, if you know how to use it properly, then that's what matters. So the first secrets I want to tell you guys is how actually banks make money on your money. How many of you have heard about fractional banking concept? Just type yes or no in the chat room here. Yes, no, yes, no. Okay, fantastic, because with that is the banks take $100,000 from you, RSP, cash, TFSA, any deposit, JSC, whatever you name it. And then they keep 10% for regulatory purposes, and they give you actually back 90% of your own money, which is kind of funny. You have 100 grand, you put it in the JSC, and then you got the money back into your mortgage, and the bank charges between 2.5% and 3.5%. I probably need to update these slides. Now it's 1 point. I just got a deal. I got a mortgage for one of my clients, 1.4% variable rate. So that was the lowest I ever got down on a rate, but on the regular bank mortgages. So the bank gives money back to you between 2.5% and 3.5%. They give money back to you in a car loan for 5 to 7%, line of credit for 8 to 10%. And what the banks love to do is to give away credit cards, because you might know that it's very hard to qualify to get a mortgage, but it's very easy to qualify to get a credit card. And the reason is just obvious, between 20 to 36%, that's what the banks charges you for the credit cards. But later on, I will tell you how not to pay more than 3%, 3, not 30, but 3% on your credit cards if you carry balances. So that's how banks work. They just kind of circle money back to you, in your own mortgage. You don't even feel it, don't even know it. So bank borrows from depositors and pay them, very, very little, 1% if you're lucky. And then they turn around and give the money to everybody else, including yourself, and receive 2.5%, up to 36%, sometimes even higher. And that's what shocked me when I kind of learned about this, financial industry, and say like, oh, I know that a lot of people has RRSP, other registered funds, TFSA, but they don't understand sometimes the concept. And actually, by saying yes or no, like, do you have RSP or Lira or TFSA, just type in what kind of accounts you have. So I can just kind of, reveal another myth that people think that a lot of banks promoting RSP. Yeah, I see TFSA, RSP, that's great, TFSA, RSP. And actually, like David commented, that TFSA has to be first, RSP, TFSA, Lira. Awesome. Yeah, so you guys have those accounts, but banks promoting RRSP is like a mutual fund. Every time we talk to the bank, in their mind, RSP is just equals mutual fund. And for everybody else right now, it's RSP equals mutual fund. But that's not the reality. RSP is just tax deferred, fantastic vehicle, but I call it just like a garage. So you have a garage, RSP, TFSA, Lira, but whatever vehicle you put into these garages depends on you. People think that the mutual fund is only one vehicle that you can put there. Majority of Canadians think that way. But this is a huge secret that people and banks doesn't tell you, that RRSP doesn't equal mutual fund. RRSP or TFSA or Lira or LEAF, RESP, like I'm a big fan of, tax deferred strategies, because one of my mentors said, in order for you to build wealth, you have to learn how to sell. you have to use that properly, and you need to find reasonable and legal ways how to pay less taxes, and then you will be, you know, prospering from it. So RRSP is not just a vehicle that banks say like mutual funds. You can also put into your RRSP accounts and TFSA such investments like direct mortgages. You can subscribe to mortgage investment corporations. You can buy public companies. Hello, hello. Looks like we are back here. I'm not sure what happened. Can you just guys please text me in the chat to see if you actually can see me and you can awesome. I don't know what happened. They just kind of disconnect me. You know, looks like the banks are, you know, checking me out here and they don't want you to know all the secrets. That's how I feel. All right, let's go back to those slides here. So yeah, with RSP, you can actually invest into direct mortgages, REITs, mortgage investment corporations. REITs is actually a real estate investment trust, public companies, stocks, bonds, you name it. But not all the people think about that. So, and if those who doesn't have RSP, it looks like everybody said, I have RSP. Well, for those people who are watching this recording, and if you don't have RRSP, go and borrow cash from the bank. I love this strategy, and a lot of people just cannot think that RSP is bad because it's a tax-deferred vehicle that allow you to build your wealth, not paying taxes right now. And your goal is to actually create a large portion in your RSP account so you can live off that and don't care who will pay taxes later. You can save and grow your taxes inside of this RSP. And when you put money into RSP, you can actually get a tax write-off. And there is people thinking that, okay, if I'm in a high bracket right now, I need to contribute into RSP. And then when I will be in a low bracket, potentially, when I was 65 and older, then I don't need to have a mortgage payment, this payment, that payment, car, boat, etc. I want to live on a cheaper kind of lifestyle. But that's not true. You're working your butts off all these years, and you don't want to minimize your lifestyle. If you're making 100,000 today, or you know, tomorrow, like basically in 65, and you're 65, you don't want to live off on only $30,000 income. But if you can, that's great, because you can actually, you know, get the benefit of it. However, I think that if you be able to grow tax-free on the tax-deferred, not tax, TFSA is tax-free, but tax-deferred method, you should do this as well, regardless, like if you're making a huge salary right now and you want to kind of cut off your taxes. It's all about the planning, right? And when you borrow RRSP, like I said, you get immediate tax write-off, so you get a refund or you pay less taxes for self-employed people. Then borrowing rate right now is super cheap. It's prime rate, 245. That's crazy what government, this COVID stuff, what happened, they just cut off the rates, 245%. And you can borrow at prime or prime plus one. And doing so, you'll be able to actually leverage smart money to build your wealth. And like I said, tax deferrals is huge. If you can avoid paying taxes now, you should do it. And here's a very simple example with BMO Redline calculator, because I'm not sure if you know this or not. BMO actually will give you $7,500, no question asked. They can qualify you for a SPI loan. Like, it's very hard to get qualification, you know, at $7,500 credit card, or might be $7,500 line of credit. But for the RRSP, it's huge. And here's how you do it. And I just put in the calculator, just go on BMO website and calculate this. If you borrow $7,500 and you pay a loan of 5%, so your monthly payment will be about $642. And during this term, you will just kind of pay about $200 interest. If you are paying, or if you invest, and you take the $7,500 and invest in a rate of return of about 8%, you can actually earn about $600. right? So you pay your cost, your monthly payment is high because 642, you have to pay down your loan, but most of it goes towards your principal reduction. So you borrow at $200, you get $600 back, so you're netting about $400. And that's a fantastic way to actually force you to save. That's how I see it. And then next year you might be buying $15,000. The caveat is here, of course, because when banks lend you money, there's no question asked. And you can actually go back and unused contribution room. Like if you have unused contribution room, you can borrow as much as you can if your debt income service levels kind of work out for the bank. Because what they want to do, they want to loan you money at, I put 5%, but it's actually 2.45 right now, from 245 to 345. So I just make it very conservative. So you borrowed 5%. They want you to put this money into their mutual funds. And which is fine, you can do that. But then probably months later or so, you just kind of, because you need to set up it as a self-directed in the first place. And then you reinvest into maybe even other mutual funds that pay a little bit better, or might be in the stock market, you know, REITs, bond funds, mortgage investment corporation, direct mortgages, whatever you name it, and generate higher yield in a safe and secure way as well. So that's a fantastic way how to use banks' money to make you money. And I love this so much that Scotiabank saying that you are richer than you think. Because I've done business, you know, for a few clients, and they always complain, oh, I don't have money to buy real estate, investment, etc. And I just keep saying, you know, telling them that watch commercial for Scotiabank. I'm not a big fan of Scotiabank. I only have one account with Scotiabank and most of my money in RBC. But Scotiabank saying you are richer than you think. And a lot of people don't understand that. However, I strongly believe that. We as a professionals who works with money help you discover this cash through the debt equity in your property that you might kind of forget about that, your other RSP, LIRA, TFSA, and other accounts, borrowing power, you know, tax refunds, etc., that allow you to actually invest for your future. Another secret I want to share with you guys and want to emphasize this, that's how important to maintain a very high credit score, very good credit, right? And this is kind of just a very quick sample here that on a $250,000 loan, if you have higher credit score, you typically pay less money. If you have lower credit score, and this is like, you see, it's like over 600, like I'm not talking about 500 and below, then you pay higher interest. And the cost for you is, as you can see here, from $1,200 on the top line versus $1,400 on the bottom line. This cost actually, you know, over the 30-year term, the difference between your credit history cost you, you know, over $85,000. That's a lot of money. That's a nice car, nice vacation, you know, multiple times a year, and a nice boat. So I want to make sure, oh, might be investment real estate component here. This might be eye-opening for those people who say, well, I don't really care about the credit, but I think you should. When I came to Canada in 2010, I forced to rent because I didn't have $500,000 to buy a house. And I was kind of saving up for the down payment. After the first year, I just bought my third property, and then a year later, I bought up to 4 properties and moved on. So with this being said, that I built my credit from scratch. Those people who don't care about the credit, they always pay the piper. That's why private lenders like ourselves exist on a different channel of lending. So please make sure you understand this, that because bank doesn't want to tell you that, because, you know, if you have a lower credit score, for them, it's a higher risk, so you pay more. Another secret that I'm so excited about is this one. That's what I promise you, that I tell you that you should not pay more than 3% on your balances. And it's called balance transfer. Some of you might know this strategy, and if you know, could you please just kind of text in the chat, say, yes, I know about this strategy. Balance transfer, I've heard about this. Banks might be sending you, you might be seeing promotional, etc. I need to know like if you are aware of this secret. Yeah, heard about it, used once. Okay, awesome. Yes, I heard it. Excellent. So some of that who heard about this, my next question is, are you actually using it? Some people did not use it, some people use it once. I'm using this all the time. And I tell people use it all the time if you're not paying, if you're carrying balances. So I want to make sure that you structure it properly. And on the balance transfer, because it's a promotional rate kind of thing, they want to take your business this way. That's why they're willing to cut off some expenses. They can give you between 0 to 1% on the rate in Canada, and with a fee is between 2 and 3%. So basically, you typically will be paying 2.99%. It will be 1% rate and 2% fee, or you pay 0% rate and 3% fee. And the term is 6, 10, 12, 18 months. I don't recommend people use term of 6 months. The longer the term is, the better the chances you can roll money over and you can make money from it, right? But 6 months term, I'm using it. I'm using it actually right now myself. I borrowed US funds because I like to take advantage of the stock market. And I borrowed money from it. They gave me term 6, at actually 3%. And I rotated this through the stock market, and within 6 months I can rotate so much, so I can just pay them back and just kind of pocket the profit. So if you're not using it, you might consider using it, because I love the strategy. My goal is to tell you about that and how you just transfer it, how you can set up. This is kind of my current transfer, my current setup for balance transfer. TD is a great for me, and they was giving me money, all the time. BMO is a good one as well. I'm with RBC, and I don't really like them because I always asking to borrow more money from RBC, and they said, well, no. But everybody else giving me money because I don't have business with them, and they want to give me money to transfer my business to them. But I like blue collar, and I like RBC. This is aligned, and that's how I keep my money with RBC. So for you guys, you need to understand there is a big difference between good debt versus bad debt. And if you type in the chat room, if you actually know the difference, or if you're using good debt for your advantage, just kind of type in the chat so I know that I'm on the same page here. So I see no here. That's fine. Okay, kind of think so. Okay, good. Because good debt, put it this way, good debt make you money and put cash into your pocket every day. Bad debt destroy your wealth. Bad debt, as you can see on the right side, that's your credit card payments, your cash advances, your vehicle payments, consumer debt, payday loans. But good debt is a mortgage, not on your principal residence, because till today you probably didn't know that you can convert your principal mortgage into money-making machine. But real estate mortgages, education, like the money you spend, because this webinar costs money, you spend this money to obtain this education. However, you need to use it. You need to apply this knowledge. Business ownership, another good debt. You invest into the business, marketing, and you actually can make more money. Real estate, like you said, investing, lending, etc. So you need to understand the difference between good debt and bad debt. However, I want to kind of emphasize this, stop, like warning, boom, 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 boom. Please do not borrow money to invest. I just kind of repeat this. Please do not borrow money to invest until you get educated enough and very comfortable with it. Because you might get greedy and that can destroy your wealth. Or if you have educated guess and educated judgments, you'll be able to build your wealth using banks' money, opium we call it, opium, other people's money, OPM. I just kind of want to make some fun here and say opium. And you can use this money, and that's how wealthy people build their nest egg, wealthy people build their net worth, etc. Because in reality, you cannot save your way to riches, to wealth, to actually real true wealth that you can pass into generation. You need to use somebody else's money or bank's money. So now we move into the segment where I want to tell you about the fantastic product, mortgage product, that if you don't have one, you should obtain one. How many of you have heard about this name, Manulife? And just type yes or no in the chat. Yes, okay. And just people who heard about Manulife, just tell me like, what do you know about that? Like, have you heard about this Manulife investment, or might be Manulife insurance, or might be Manulife bank, insurance? Yeah, because that's what majority of people have heard about Manulife as a company pension with them. Yeah, that's basically group insurance. That's basically what people have heard about Manulife is an insurance company, because that's how they structured. So Manulife formerly manufactures life insurance company. That's how Manulife came into the fact. It was like over 133 years right now. They're in financial services, and they are in insurance mostly. And they are in $1 trillion in asset under management. That's a lot of money, under management. It's one of the biggest insurance company in the world. There is another one, Sun Life Insurance. Probably you've heard about this as well, on an insurance component. And it's this insurance company was as well over like 150 years old, and also with insurance. And they almost have $1 trillion in assets under management. So there's a humongous companies. But how many of you actually heard about Manulife Bank? Can you just type in? Have you heard about Manulife Bank? Yeah, no, of course, because the banks and insurance company promote insurance. No, you didn't hear. Yes, that's correct. Like, no, okay, that's not a lot of people have heard about Manulife Bank. And the reason is because they don't advertise, they don't promote this. So they want to keep it kind of for themselves. So it's Schedule 1 chartered bank. It was established in 1993, so long time ago. So and that's why, because they have insurance component, they have so much money, they want to lend it out. And they only opened it up in 2016, like only a few years ago. Can you imagine that? Like, they opened it up for broker channel like us. But before, it was only available through financial advisors. And type in the chat below, like, if you have financial advisor or heard about financial advisor who have access to these products. The chances are, like, if you do not have financial advisor, then you probably haven't heard about this product and never done that. And I want to change it. I want to make sure that everybody is aware about this fantastic product called Manulife One. And if I go back to the slide as well, another big fact of it, that not all the people are aware of it, because mortgage brokers like our firm, they don't have, first of all, they don't understand the concept. Second of all, it's too hard for them to sell it to their clients and get the mortgage deal away. And third of all, Manulife doesn't pay us enough to promote their product in a better way, which is kind of ridiculous. It's a fantastic product. It's a premium product, but they don't pay us enough. And which is like, wow. And that's why mortgage brokers doesn't really sell it. It's better they go for a higher commission. You need to understand salespeople that way. Nothing wrong with that. And you can get other mortgage products, that might be suitable for you. But I think this one is the best one. How Manulife One works is actually you have one account, all your income coming in one account, and then you have sub accounts where you can pay your bills, you can save for retirement and pay your mortgage, which is very, very convenient rather than have a checking account and then there is a mortgage and line of credit, etc. It's like all in one. And might be in the first place, you might heard about that, oh, it's kind of interesting to have that. However, it's super fantastic product in a way that by keeping all your money when your income coming in, and you will see in the next slides, you can cut off your debt much, much faster that you cannot do with traditional mortgage. And actually traditional mortgage is designed for the banks. It's a benefit for the bank, because if you know, the mortgage from Latin means, pledge to death. So they don't want you to pay that faster. It's not like how the banks operate. Another huge advantage about compound interest, because you might know that it's very good to have, compounded interest that's kind of working for you, but when you pay it, it's not so good. Let's say you have $400,000 mortgage and you pay 5% a year. So basically, your total cost for interest will be $20,000. And bank already earned interest from January 1st to July 31st. And that's because they do, like in Canada, they have semi-annual compound. So basically if, oh, look, if on somewhere in March, you got a big bonus and you want to pay, $10,000, first of all, the money will go towards interest and then principal. And that's what people kind of say, oh my goodness, like I have so much more cash coming in and I'm trying to pay off my mortgage faster, but in the first 5 years, all the money goes to the interest. That's, thank you for the semi-annual compound for the banks. However, compounding semi-annually versus daily interest, that can, help you a lot build your wealth and pay off your mortgage and also decrease your interest cost. So with Manulife product, because there is a line of credit component into it, there is a daily interest. If you get a check from, from your employer, you get a bonus or you sell some of the things and you have some big chunk of money coming in, you can apply all this money towards your debt. And while you're not using it, you can save on cost for the interest, which is huge. And also there is a difference between traditional mortgage and Manulife mortgage is, like I said, entire paycheck on Manulife One can go towards your mortgage. With a traditional mortgage, you might have what's called limitations. So you cannot pay down, they limit you, you can pay only 10% per year, might be 20% per year. You have some limitation for double payments, you can pay more. There is no such limitations in Manulife because there is line of credit component into the mortgage built in. And it's like traditional mortgage is very rigid, where the flexible solution for Manulife allow people to have, those people who are self-employed, they have their own specific product. People who are savers, they have their own specific product. People who are spenders, they have their own specific product built into Manulife. So it's just kind of adjustment of your revolving portion of line of credit. And actually, I want to do this little exercise for you guys. So please take a screenshot of this. And I want you, when you kind of gone home, I want you to test your own numbers. And I want to show you this Manulife One calculator online, how it works and how it actually can pay you that faster, like much faster, which is kind of crazy, without even any addition of Smith maneuver, etc. Like, which is like another powerful strategy that come with the Manulife One. So let's go back and just gonna Google it, Manulife One calculator. And when you Google it, here it is. Just click on that, and you will see this calculator. And I want you to practice and put your real number in. For the purpose of exercise, I will just kind of put, assumptions here. So basically, your home value is $500,000 here. Current mortgage balance, we will put 350,000, and you're just gonna put your own amount. Interest rate, you're paying 3%. You're paying monthly. How much is your mortgage payment? Basically, if you run the math at 3% on $350,000 loan, you will be paying about $1,656 a month, right? And then we go and we click. Let me just put a little bit here. We click next, and then it's asking you for your savings. Let's say you have $3,000 in your checking account. Saving account might be your rainy day, or might be your tires, or might be emergency, or might be vacation. Your $5,000 there, and let's say you have another $5,000 in your TFSA for short-term savings. So, in terms of the what is called credit cards and other liabilities, we don't put that we pay credit cards every month. You should, if you don't, then use my secret where you can convert 3% money and use it for your advantage. So let's say you have outstanding balance of $10,000 at 20% interest, and your monthly payment is $200 a month. Let's put it that. car loan, you have a very nice car for 20 grand, 6% interest, and you're paying $400 every month. And you have personal line of credit or personal loan, you just do for $10,000. Loan interest 10%, $250 a month. That's basically average scenario for average Canadians. If your number is different, please use your own. Cash flow. So I put income $5,000 after taxes, so it's net, right? $5,000 net. And basically, after you pay your mortgage and your debts, you spend all the money. Might be left $100, like living paycheck from paycheck to paycheck, $230. Well, it's big score, but we can work with that. So I thought it will be about 60,000, but let's do this way. So if you have your income coming to your home, to the Manulife, I call it home, Manulife One account, coming to that, then without any strategies, you can cut off your mortgage much faster, because like I showed you, you have a little bit of cash left. And if I go back and I show that there is no cash left, like all the money after paying expenses and other debts, because it's kind of more typical scenario, you've got your mortgage cut off by 9 years, because all your income coming in into the one place, while you're not using it, while you're not spending on groceries, etc. A couple days here, a couple days there, because I told you about the difference between daily interest versus compound interest, you actually save on cost. So these savings equal, $67,000, the difference between your typical mortgage versus Manulife One. And this is just kind of for Manulife One only, right? If you spend more money, in your negative position, that your numbers is changed. That's why we can schedule a consultation. You just need to email me at yes@k5mortgage.com, and we can run your numbers to see, and you can exactly understand that. So that's the power of this Manulife One, and I will show you here. So that's what we used as an example. You can be richer by $61,000, first of all, in interest cost, and you can cut off your mortgage, and that's what we use in like 25 years, so you can shorten your amortization period very efficiently, right? And this is assuming that, as you can see here, you're paying 3.79% interest rate, right? Which is like way too high in today's market. And probably right now you probably pay close to 3%, 2.7, 2.8 on the Manulife One versus like 1.9, 2% in a traditional mortgage. But you'll be able to cut your mortgage faster. And that's what is important for you. Save a little bit of dollars and feel nice because you got under 2% mortgage, or you should pay off your mortgage faster. So, and that's what all excess cash that you have, you just can dump into the mortgage. Like I show you, you have like $3,000 checking account, you have $5,000 in savings, and maybe another TFSA. I wouldn't touch TFSA, but I will take the cash component and put it into your Manulife One, so you can actually reduce your debt level and pay less interest. So whatever dollar that left in this account, if you don't spend, then lowers your debt automatically. You don't need to worry about that. And this is powerful because like today I transferred, $2,000 from my investment account and another $7,000 from another account because they were sitting and I was so busy to do that. And I would just kind of rather to put this into one so I can reduce the debt, which is very powerful. So I want you to kind of understand this. And like I mentioned, if you have like travel money, we call it travel money, what if money, winter tire money, your vacation, like you name it, like the kids' braces money, whatever you're saving aside, you want to make sure that it's, because right now it's earning you 0.1%, which is nothing, or they can save you, in our example, 3.79%, which is very powerful. People, like I am kind of trying to explain people that emergency, like mental health is not for wealthy people. you have peace of mind because you have $5, $10, $20,000 in your pocket. But if you can lower your debt load, like if you have so much money, you know, and no debt and no mortgage, then you don't need to worry about that. You're just going to spend whatever money you have. However, if you use it and you put off, instead of sitting in a checking account, putting towards your debt or mortgage like Manulife One, you can actually become much, much richer and much, much wealthier. Because, and you can also borrow it back when you need it. So, and in most cases, when people have some sort of emergency, they use it, you know, from a checking account, and probably in a couple of months, they top it up. So same applicable for your line of credit of some sort, right? So my motto is that all your money has to work harder. You need to operate from a broke mentality. So you have zero cash account on hand and everything working for you. Like soldiers, they're going on the war, they chase another money, they bring it to you. So there is no idle zone. Like I hate when people have money in their accounts and they sit in an idling, and it's like, wow, that's not good. You just need to kind of educate yourself, you know, to become wealthier. And here's another tip I want to share with you while we're coming off to the end of the presentation: how to use the bank's money for free for 21 days to pay down the debt. Manulife Bank has offered as well is a Manulife credit card, which is a very infinite, Visa Infinite, very premium card that it's cost $100 a year. And it saves you $17 a month for Manulife One account if you have one. They give you cash back at 3%, 2% on travel, and 1% on other expenses. And if you spend, you know, about $1,600 every month, and that's what majority of people spend, like if you're making 100 grand, then you'll be able to get free Manulife account. And also when you get the savings, you know, like if you spend this kind of money, you'll get about $200 savings using credit card. So even if you pay $100 a year, you can earn money from your credit card. Not a lot of people actually making money from credit cards. And it seems like a small amount, not worth doing it. But if you're spending this anyways, you should get something back, plus enjoy free services, as well as a 21-day grace period. That's what I call free money. So within 21 days, you can do whatever you want. And here's how I play the spending game and trying to educate my clients and people like yourself, investors, who want to be smart with some money or smarter. Then you need to know how to play a spending game. When your paycheck coming in on the first of every month, you need to buy groceries and other expenditures using your credit card for 21 days. And then you have 21 days to pay it off, right? Like you're paying it. And then you move your car payments from the first of every month, like everybody has, to the 22nd, right? So basically you postpone the payment. And this postponement, if you don't take this money, will be sitting in your Manulife bank account, saving you money every day. And then on 22nd, you just kind of pay your car off. You also set up automatic payments on your cell phone bills, subscriptions, etc. on the credit cards. So every 21 days, you just kind of pay off your credit card. It's a kind of automatic thing, right? Because if you keep balance on your credit card, then you're paying like 20% plus. You know, that's what I'm doing for my businesses. I want to make sure that there is no money going to the bank, you know, in terms of high interest. Every billing cycle, the credit card has to be paid off. So you use this in a smart way. And when you set it up, you don't need to worry about this anything else. It just kind of, you build a new habit. And the longer you wait to spend your paycheck on the first, the richer you will get, which is a very simple game. And I encourage you guys to try to play it. And I can be your accountability buddy just to see if you're actually delivering it and actually committed to that for your wealth and success, because I am 100% committed to your success, you know. So now we're going to wrap up the conversation, and I want to briefly talk about this fantastic strategy, Smith maneuver. And I will actually share with you a little calculator, how you can see what the Smith maneuver can build wealth for you, like what I'm talking about. Convert your traditional mortgage into money-making machine for you. The Smith maneuver allow you to eliminate your non-tax deductible mortgage debt faster, generate valuable tax deductions every year where you can apply towards your mortgage payment, and you can invest for the future starting right now. So you can add at least $450,000 to your net worth over the life of the mortgage. And this is like humongous. And the Smith maneuver itself was another webinar series that I will be doing the next couple of weeks. And I want to do also this very small and intimate group to make sure I can answer the question at the end, because this is huge. You know, not all the people know about this. This strategy, legit, in existence since 1980s. It's working. People just don't aware of it because banks doesn't promote these products very well. And Manulife One is one of the best among the other banks who implement this kind of structure for the mortgage, because you need to have a right mortgage, the advanceable mortgage, to use this maneuver. Because we've been taught that you need to first pay off your mortgage debt fast, you know, then you need to help kids with education, and then you start investing for retirement. And after 25 years, you're paying off your mortgage, maybe you can shrink off by 20 years, might be even less. Then you don't have maybe energy to start for investment for retirement. And you can do it right now as you're paying your mortgage, because Smith maneuver not allow you to inject any new money here. But I want to make sure that you understand how it works. And you need to sign up for a next session. We will receive email notification later in terms of this specific strategy, because we will just go dive deep into this. I will share like for a couple of minutes how this works and how you can build, you know, your net worth by $450,000. So this steps is actually absolutely wrong. You can do it right away. You can save right now, and you can pay off your mortgage years faster, which is really cool. And like I said, well, I would say Scotiabank said, you are richer than you think. And you also need to think about this right now. Every time you say, oh, you know, I'm short on cash, I don't know how to put this money into investment, look for your best friend, which is Scotiabank. So this is what, like, I'm talking about, this secret, the Smith maneuver, advanced strategy. It combines Manulife One. That's why I described you a little bit about Manulife One, because if you don't understand Smith maneuver, that's kind of my job to explain this to you properly. But Manulife One on its own can actually help you to generate pay down on your mortgage. With Smith maneuver, you just add extra, you know, 400 at least, $1,000 into your nest egg. So while I'm setting up, I want you to think about any questions you might have, and I will show you a quick demo here with a Smith maneuver calculator, so you can actually show it, so you can actually see it. And I should probably open it up before, but I have a smart borrower over here. And I put for the smart borrower is $100,000 income that we used in the previous example, gross income. I don't put any other income, pension income, investment income, just for the Smith, plain Jane Smith maneuver strategy. So you're making basically $100,000 in terms of assets. I just put only $10,000 that you have in stock and $5,000 for emergency. For liabilities, I keep it zero. And we have a strategy how you can convert your debt and consolidate your debt to make sure you have zero liabilities. Zero bad debt. Good debt is good. Take good debt as much as you want, as much as you need, and build your wealth that way, if you know what you're doing. Marginal tax rate, if you're making about $100,000 a year, you're probably paying 40%. I make it 35 to make it conservative as well. And then mortgage information. For like our discussion was $500,000 mortgage, home value, $400,000 mortgage, interest rate we set up for 3%, amortization 25 years, monthly payment about $18.93 a month, and there is a advanceable line of credit which will be set with Manulife One at 2.5% plus prime, prime plus 1%. So your borrowing rate is about 3.5%, which might be seems like so high, but that's not the point. And in investment assumptions, what we can see here, like I might be noticed with the advanceable mortgage, when you pay down your debt, a line of credit component kicks in because you pay principal and you can borrow this principal to invest for the future. And in our case, like after you paying $1,800 a month payments, $700 will be available for you to invest in the first month, and it goes 750 next month, 760, etc., until you're actually paying $1,800 towards your principal all the time, and then you just reborrow it back. So if you use 8% growth rate for your portfolio, stocks, bonds, mutual funds, real estate, businesses, lending, that's what I'm doing, then you'll be able to increase your net worth by $407,000 because the time works in your favor. By the end of the 25 years, when your mortgage is paid off, you will have a real investment portfolio of about $740,000. You will still have a debt, which is investment loan, which is $332,000, because you convert bad debt into a good debt, so your loan doesn't go away. But if you decided to liquidate portion of your portfolio and pay off your mortgage here, then you have a net worth improvement by $400,000. And you also kind of shave off a little bit of your mortgage from 25 years to 23 years. The huge thing is that you'll be able to benefit from tax savings. I don't know any mortgage product that allow you to save taxes. You know, a Manulife One combined with Smith Maneuver can do this. So there is total tax savings about 46 grand, and total tax deductions over this 25 years about 130 grand, which is huge. But let's put this that way, that yeah, because we recommend that all the refunds that you get from tax deductions go back to your mortgage. But let's say you have, might be $100 every month that you'll be able to contribute towards your mortgage. This $100 every month in reality cost you about $90,000 over the term of your mortgage. So you can build up $500,000, almost $500,000 in your net worth improvement. So your investment portfolio will be looks like 835. When you pay off your mortgage at 339, then you have about $500,000. So that's only few things that I showed you in this calculator, because there is other, that swap accelerator, cash flow demo accelerator for people who owns real estate. That's huge for people. DVD reinvestment plan accelerator, prime the pump. I will share this strategy on my next webinar because we need at least another 45 minutes or so to go over it. I just want to give you a little bit of teaser here so you can guys sign up for the next webinar. And right now I want to move basically into the Q&A session and answer all your questions. So what do you feel so far? Share with me. I'm asking like if I be able to get a copy of the slides. No, we send you a webinar recording if you want to use it, but those slides not be shared. So you cannot just use them for your purposes. So guys, ask me any question that you might have right now, because I want to make sure you're going home to your kids, to your family, friends, loved ones, wives, husbands, and got excited about that. I also want to make sure that you email, like if you need more information and you want to set up a private one-on-one consultation, you go and email at yes@k5mortgage.com. This sounds very interesting. Fantastic. Thanks for sending me the book. You're very welcome. Yeah, for those of you who received the book, and that's kind of my gift to you. If you didn't receive a book yet, just let me know, send me email so we can chat more about that. And of course, you need to learn more about it. That's why I'm doing these small webinars to kind of explain step by step. This webinar says like, you need to know what kind of mortgage component you need to have, because without the proper mortgage setup, you cannot use Smith Maneuver, right? Because a lot of people say, well, I have a mortgage already, I need to break it. I said, yes. How much is your penalty? Oh, it's like 3 grand, 5 grand. It's like, who cares? I have a client who is actually paying right now $21,000, or thinking to pay $21,000 to break their mortgage to get into this, because $500,000 for him over the term of the mortgage seems more attractive than have a little pain of 20 grand. Because this 20 grand, it's not your out-of-pocket expense. It will be amortized over this 25-year period. So you will not even feel it. I have another question. Is it possible to combine Manulife One system with a Smith maneuver? Yeah, but that's the only way how Smith maneuver will work. Smith maneuver works only with readvanceable mortgage. Smith maneuver doesn't work with a traditional mortgage when you pay down your debt and you cannot use any money to reinvest to have tax savings. You're just kind of paying down your debt, and by the end of the 25 years, you have free and clear title, right? And let's say your property doubled in value. You have a property of 500,000, you pay down your debt till to zero. Now you have an asset of $1 million and zero debt. This is Smith maneuver. In this example, you have $500,000 more property, you pay it down, you reinvest, so your loan stays the same, goes to $332,000, and you have $800,000 extra investment portfolio. But if you choose to liquidate this $300,000 and pay this $300,000 loan, then you have a property worth $1 million over 25 years. You have extra 500,000. In traditional world, you will have just only paid free and clear house. So you become 500,000 richer with Smith maneuver. Thank you for the book as well. You are very, very welcome. What other tools in the market are there other than what Manulife offers? I'm not quite sure about the other tools in the market. You mean like another advanceable mortgages, if that's what you mean, Hitam? Or you mean other secrets? I can share other secrets like in a separate thing because I want to make sure that I'm cautious about your time. And this other mortgages, Scotia Step has one, but they're not exactly the same how it works. Like if you have Scotia Step, you can consider tweaking it and make it work. RBC has one. CIBC was a big one, like till 2012, I believe. CIBC was a big one for this thing. Like they had a very good first line mortgages. It was huge. But since then, like Manulife has the strongest position. So, and it has a very flexible terms as well. Isabel asking, is it only for principal properties? Yes, Isabel. Because if you have investment property, investment generating property, revenue property, that the interest on this loan, it's already tax deductible by default. But in Canada, compared to our friends in the US, we cannot deduct interest on our principal residence. In the US, you can. In Canada, you cannot, because in Canada, you have another trick that you can actually have a capital gain exemption. However, with a Smith maneuver, you have both worlds. You have capital gain exemption as well as you can deduct your interest. So yes, you can. That's only for principal residence, and that's what you're doing if you're just gonna convert your bad debt, because mortgage on your principal residence is a bad debt, and your goal is to convert it as soon as possible into a good debt. You're very welcome, my friend. Awesome, Tyson. I'm in for more secrets. Stay tuned, because those secrets can overwhelm you. I'm trying to give you the easy ones, to chew. But if you have any questions, because I want to kind of wrap it up, like I promised, not more than 8. I wanted to wrap it up unless you have other questions and everybody's okay to stay a little bit longer. But if you have any questions, like I said, you can send them off to yes@k5mortgage.com, or you can book a free consultation, for 5 minutes, or maybe 10 minutes, or maybe 15 minutes. So we can actually basically analyze the situation to see what will be the best fit. So either yes@k5mortgage.com or send a book at constantine.com. If you're interested to contact, like we just kind of discuss this with you on a one-on-one basis. We sign on disclosure agreement, so you can share the exact numbers. But I want you to Google Manulife One calculator, just play it with it because Smith maneuver calculator costs money. And that's why it's like $60 or something. But I want to make sure you are aware of it, and I can run with you in your numbers. I just kind of build the report there. Any other questions, guys? Did you enjoy the webinar? Did you enjoy some of the tips and tricks? Awesome, awesome, awesome. Love it, love it. Thank you so much. Thank you, David. Thank you, David. Thank you, Isabel. Latif. Thank you, Phil. I'm very grateful to be a part of your life right now, because I can bring much more content into your life in terms of mortgages investment, like I said. And I would love to stay in touch, stay committed to your success. And I'm also looking forward, to serve all of you guys. Last comments, last questions before we kind of cut off. You're very welcome. You're very welcome. Another minutes we can wait. All right, guys, let's do that. Let's wrap it up. Send your questions or might be comments into this email, yes@k5mortgage.com. And I'm looking forward to seeing you and speaking with you. Okay, bye-bye.